Welcome to No Nonsense Nonprofits. Hi, I'm Sandy Ray, founder of Sandra E. Ray CPA, where we alleviate financial headaches so that you can create a bigger impact. Today, we're going to talk about private foundations. We do a lot of talk about public charities. Private foundations are wonderful organizations and they do loads of good work. But if you're a private foundation, there are some things that you need to be aware of, and especially the excise taxes that go along with being a private foundation. A private foundation is generally a tax-exempt entity that is controlled by a person or a group of related people. Therefore, they're considered public charities, but the charitable donation is less than what a 501c3 would be able to give. There's some limitations on what donors can give. And these persons or related people, they're going to have significant control. So it could be a family private foundation. It could be something like Bill and Melinda Gates. It could be just a single person. So we want to be aware of who those disqualified people are. And we call them disqualified not because of any connotation. It's just that they are major contributors or they have major influence over the organization. Now, taxes imposed on private foundations are similar to those imposed on other tax-exempt entities. They have to look at unrelated business income tax. Of course, they have to pay any payroll taxes. What I want to focus on today is the excise taxes that are imposed on private foundations. A lot of them have to do with the restricted activities and if there's any violation of those restrictions. So I want to start first with one that is not a restricted activity, but is very common for private foundations, and that is the net investment income. Now, there's an excise tax that private foundations pay of 1.39% on net investment income. And that is your gross investment income plus any net capital gains minus allowable deductions. And I kind of want to go through each component. Your gross investment income includes your interest, your dividends, rents, payments related to security loans that you receive, royalties. But I want to be very clear that if any of this is related to unrelated business income and is included in the calculation of that tax, it is excluded from this tax. Your net capital gains from sale of property is going to basically be your investments, including your dividend capital gains. But it's also any property that's held for investment. That could be real estate, works of art, or collections. And again, this income is excluded if it is tied to unrelated business income, and it is included in the calculation of that tax. And then our allowable deductions are any ordinary and necessary expense paid or incurred for the production or collection of gross investment income. Now, to break this down into examples to make it easier to understand, we're talking about investment management fees, real estate taxes, depreciation. Those are the kinds of things that you get to deduct from this income before we calculate the tax. The next tax is kind of like a tax to avoid this activity, and that is the tax on self-dealing. Self-dealing has to do with transactions between the private foundation and the disqualified persons, which, as we said before, is a person or a group of people that are related who have significant influence over the governance of the organization. It could be because they gave a lot of money, or even if they didn't give a lot of money, they're related to somebody who does, or a group of people gave smaller chunks, they're related by family or business ties, and together they're donating a lot of money to the organization. Now, this tax is 10%. There's several layers actually, but if there's somebody who's not a foundation manager who is acting as a foundation manager, there's a 10% tax on that transaction. And these taxes are paid by the person, not the foundation. So they're reported on a form other than the 990 PF. If it's a foundation manager who knowingly participates in one of these transactions, there is a 5% excise tax imposed on them. And here's the kicker. If we find that this is happening and we don't correct it in the current tax period, there's an additional tax of 200%. Let me say that again, 200%. So the IRS is not saying, okay, you made a mistake, just get it fixed. There's a penalty that goes along with it to help you avoid it. But if you made the mistake and you don't fix it, we're going to hit you hard. And that happens with several of these taxes on the excise tax. The next tax I want to talk about is the failure to distribute. Private foundations are required to distribute their funds. And there's a minimum that has to be distributed. And that minimum is 1.5% of the excess fair market value of your assets over your indebtedness related to those assets. Now, that sounds like a lot. So think about if you have an investment portfolio, but you also have a loan that's providing you money to invest. That's what we're talking about, the fair market value of that investment portfolio minus the loan that's required. And so the minimum investment is you have to disperse is 5% over that value. But there's some things that you can subtract. For example, any taxes that you paid on the investment income, you can subtract that before we calculate the 5%. Any qualified distributions that you did make get subtracted because we're only looking at the amount that wasn't distributed. And then, of course, because we're talking about fair market value and gross income, the cost basis of any property that was sold or investments that were sold. But we also have what's called set aside funds. If you have a project that's coming down the road and you are saving up for that, you can set aside funds, and there's a mechanism that involves the board and minutes of the meeting and a resolution, but you can set aside those funds for that purpose. So that can be done as well. And those set aside funds get deducted before this tax of 30% of what you did not distribute gets imposed. So that's a fairly complicated calculation, and I've just hit the highlights. So if you think you need to look at that, then I would recommend you go to the IRS website. They have a very good private foundation, the life cycle, and it talks about each one of these taxes and gives you great examples. The fourth tax I want to talk about is taxes on excess business holdings. Now, this tax is 10%. And what we're talking about is within your investment portfolio, do you have, along with these disqualified persons, more than 20% of the business? Do you own more than 20% of voting stock of a corporation? Do you and your qualified persons own more than 20% of a partnership? If you do, that excess is going to be taxed at 10%. And if that is not corrected before the end of the tax year, we have another additional tax of 200%. And it's going to be taxed on the excess ownership that you did not dispose of by the end of the year. The fifth tax I want to talk about is taxes on jeopardizing investments. You said, what's a jeopardizing investment? This is any investment that would make the organization financially unable to carry out its exempt purpose. And additionally, there's some things that go into this definition where the managers have to perform reasonable care and prudence. If you're not performing reasonable care and prudence when you're going into determining what investments you're looking at, the IRS can impose this tax. Now, this is for both long-term and short-term. So you have to look when making these investments, what's the long-term benefits? What's the short-term benefits? What are the costs associated with that? Is that going to interrupt our finances so that we cannot carry out our exempt purpose? Obviously, you're going to have to take into consideration the financial needs of the organization. It might be easier if I give you a few examples, and these are the things specifically on the IRS publication regarding the types of transactions that would be considered to jeopardize the organization. They are trading in securities on a margin, trading in commodity futures, investing in working interest in oil and gas wells, buying puts, calls, or straddles, buying warrants, or selling short. So I know that's a lot of investment terms, but those are the items that are specifically excluded from what would be considered prudent and reasonable. And I want to mention that both the private foundation and the managers are liable for this tax at 10%. The sixth tax I want to talk about is tax on taxable expenditures. Now, there are some things that you can do and expenditures that you can have, but you're going to be taxed on them at 20%. And I want to talk about what those taxable expenditures are. Basically, any type of lobbying, propaganda, or attempts to influence legislation, influencing the outcome of a specific public election, influencing the outcome of a voter registration drive. That's all related to lobbying and our election process. Other things are giving grants to individuals for travel, study, or other similar purposes. Making a grant to an organization that is not a tax-exempt entity. And carrying out any purpose other than religious, charitable, and education. Now, please understand that there are some very specific exemptions to all of these things that I just listed. But the tax on these expenditures are 20%. And if you have any of these expenditures, you're going to pay tax on it. It's kind of like you bet. It may be something that your board feels very passionate about, something that we need to do. And if that's the case, then you're going to go ahead and pay that tax along with paying those expenditures. Okay. So that was the last one. I need to make a correction. If you don't correct this last section of taxable expenditures, they really are not supposed to be allowed. I'm sorry, I misspoke about this. There is an additional tax of 100% if you don't stop making these and not correcting these during the tax year. And I apologize, that was a big error on my part. I want to make sure that you all understand that. Okay, now to summarize, for these reasons, it's imperative that private foundations and their management teams and the disqualified people are very aware of what these restrictions on their activities are, what taxes can be imposed, what taxes are imposed as a result of them just being a private foundation. We want to take action, obviously, to avoid the 100 and 200% additional penalties and make the correcting actions as quickly as possible. In order to do this, we want to be monitoring our investments and the income generated from them before taking any action to buy or sell. We want to be monitoring our investment holdings, making sure that you're aware of the holdings of the disqualified persons as well. We can't have significant amounts of holdings in any business entity. We want to monitor our distributions that we have given out as they relate to what the minimum is that we're required to distribute. And we want to do this throughout the year. We do not want to get to the end of the year and go, hey, we're $10,000 short or $100,000 short or wherever that is. We want to avoid actions that aren't allowable, like self-dealing or expenditures, grants to organizations that are not nonprofits, or just any expenditure that is not religious, charitable, or educational. I want to say that when operated with this knowledge of these requirements, private foundations do a lot of worthwhile work. They're the backbone of the funding for many tax-exempt organizations, and I don't know what we would do without them. So if you're involved in a private foundation, please make yourself aware of all these rules and regulations so that you can increase your impact. And we really appreciate the work that you're doing. I hope this was helpful for you today. And if you have any questions on this or other topics, please put something in the comment section below. And of course, we always appreciate your likes. And I want to thank you for joining me today. Remember that creating a bigger impact starts with stopping the nonsense. If you're dealing with nonsense in your nonprofit organization, we'd love to help you cut through the noise.